a measure like something called open interest for both Ethereum and Bitcoin are at record lows at a time when the technicals for both Bitcoin and Ethereum are flipping positive. So I think you're going to see a crypto rally into the end of the year. And it really does help to see JP Morgan say they're open to the idea of using crypto as collateral.
You've seen the Fed's standing repo facility, which is an emergency financing tranche, being used quite heavily twice. And you've had Jay Powell, the Fed chair, de facto announce on Tuesday that quantitative tightening was ending. The system needs more liquidity. The bottom line is that simply ending QT is not enough. They're going to have to do a lot more than that.
When markets shift, it rarely happens by accident. Beneath the surface of every rally and every crash lies a deeper story, one that connects liquidity, policy, and investor sentiment into a single global rhythm. Right now, two of the world's most respected macro strategists, Tom Lee of Fundstrat and Michael Howell of Cross-Border Capital, are pointing to that rhythm again. Both are seeing signs that the next major upcycle in risk assets, especially Bitcoin and crypto, is being set in motion. Tom Lee has been one of Wall Street's most consistent bulls throughout 2024, and his outlook for the final stretch of this year is even more aggressive. He points to record-low open interest in Bitcoin and Ethereum, a sign that leverage has been completely washed out, just as technical indicators flip positive. In his view, that setup, combined with growing institutional adoption and improving risk sentiment, could ignite a powerful crypto rally into year's end. And now, with the Federal Reserve pausing rate hikes and preparing for deeper liquidity support, his thesis might have just found its perfect macro tailwind. That macro tailwind is precisely where Michael Howell's work becomes critical. As one of the foremost experts on global liquidity, Howell warns that the system is showing early signs of stress. Repo markets are tightening, balance sheets are stretched, and the Fed has quietly admitted that quantitative tightening is effectively over. The next step, whether they admit it or not, is to inject liquidity. Because, as Howell explains, the system doesn't just need stability, it needs cash. And when that flood of liquidity arrives, history tells us exactly which assets benefit first: Bitcoin, Ethereum, and risk assets across the board. In today's video, we'll explore how Tom Lee's bullish technical outlook intersects with Michael Howell's liquidity cycle analysis, and why many analysts believe this combination could mark the beginning of crypto's next major leg higher. Don't forget to hit the like button, subscribe to the channel, and stay tuned until the end as we break down how this liquidity shift could shape the crypto markets heading into 2026. What if I told you there's a way to grow your crypto tax-advantaged and receive a $100 bonus just for getting started? WTFinance has teamed up with iTrust Capital, the #1 platform that allows you to buy and hold crypto within a self-directed IRA or their brand new Premium Custody Account, PCA. That means you can trade over 80 top cryptocurrencies: Bitcoin, Ethereum, XRP, Solana, and even trending tokens, as well as gold and silver, while keeping your gains protected from heavy tax bills. Here's what makes iTrust Capital stand out: tax advantages. Legally defer or even eliminate capital gains taxes on your crypto. 24/7 trading access. Buy and sell crypto, gold, and silver anytime, anywhere. Low-cost structure. Only 1% per transaction, with no monthly or hidden fees. Security first. Institutional-grade custody partners keep your assets safe. Simplicity. Sign up in minutes. Roll over funds from old employer plans, or even transfer crypto directly with in-kind transfers, something few providers offer. Instead of losing thousands to the IRS, every dollar stays compounding in your account, building the future you actually want, all while holding the assets you believe in most. And here's the best part. When you sign up and fund a new iTrust Capital IRA or PCA, use promo code SAVVY9, and you'll claim your exclusive $100 funding bonus. That's SAVVY9 for an instant $100 bonus, exclusively for savvy investors like you. So if you're serious about growing long-term crypto wealth, this is the smarter, safer, and more rewarding way to do it. Hit the link in the description, sign up in minutes, and put your crypto in a structure built for growth.
So why should investors be more bullish on risk assets, the market overall, than they were 6 months ago?
Well, John, even at the April lows, just to be clear, our S&P year-end target was 6,600. So we were still expecting explosive recovery in markets. But we are above that level. And, we're 10 weeks before the end of the year and the S&P is at 6,800. I think it's still a base case then for people to say that in just a typical year, the S&P should gain another 4%. That would put us over 7,000 into the end of the year. And I think that that's sort of the minimum. But because we've got the Fed cutting, and they started in September, they've been on pause all year. That only happened twice in the last 50 years, which is 1998 and 2024. I actually think the S&P, given the skepticism that's been plaguing this market all year, we could do far better than 4%, maybe even 10% into year end.
Wow. Okay. So where does crypto fit in, especially when you're looking at how those currencies are moving versus what's happening with tariff concerns, global trade concerns, et cetera?
Crypto had a huge deleveraging event on October 10th, and part of that was triggered by the escalating tensions with U.S. and China on tariffs and trade. And that was the biggest liquidation event in 5 years for crypto. So there is still those ripple effects, 2 weeks later that are plaguing the crypto market. But I think we're almost through that because a measure like something called open interest for both Ethereum and Bitcoin are at record lows at a time when the technicals for both Bitcoin and Ethereum are flipping positive. So I think you're going to see a crypto rally into the end of the year. And it really does help to see JP Morgan say they're open to the idea of using crypto as collateral. I think it's sending a pretty bullish signal. Part of it is it's a counterfactual statement, but crypto had the biggest liquidation event, deleveraging event in history. The number is probably multiples of what happened during FTX, and Bitcoin ends up down 3 or 4%. So I think it shows you that Bitcoin itself is proving to be a pretty good store of value, because if we had seen this happen with gold in the gold market, if there was a huge deleveraging event and gold was only down a few percentage points, we'd of course consider that a real validation. And it's also true of Ethereum, because Ethereum is seeing so much activity growth. On the L1 and the L2 because of stable coins, and it's not reflected in the price. It does take time. So to me, because what I'd call the fundamental activity on Ethereum is really picking up, it argues for a pretty big move into end of the year as well.
Tom Lee's message is clear. The market has already weathered its biggest tests, and the path forward looks surprisingly strong. He points to the Fed's renewed dovish tilt, the resilience of crypto prices after the biggest liquidation event in 5 years, and the historical pattern of year-end strength when policy turned supportive. It's a setup that reminds investors how closely crypto mirrors liquidity-sensitive assets like the S&P 500. And that's where Michael Howell's analysis takes over, because understanding the timing and depth of this liquidity shift could determine just how far this bull market runs.
Well, I think the thing to start with is, where we are in the liquidity cycle. And, we've been warning for, a few months now that we're getting near the peak. We haven't really been going risk off, but we've been saying that we're getting closer to that peak, and that peak could be, a watershed clearly for risk asset markets. It was great on the way up as liquidity was going into markets, and it may be a pretty difficult ride on the way down if that roller coaster starts to dip and start to go back towards a trough. And that is really the danger we've got to try and spot. We've been arguing that if you look at the liquidity cycle, it was anyway slated to peak sometime later this year, probably early or possibly early 2026. A lot of people are suggesting it's different this time. It's always dangerous to say that. So I think we've got to be alert to the normal tempo, the normal frequency of the cycle. And that says that we're in the grey area now, where the cycle could end fairly quickly or fairly soon. And we've got to be alert to that, any tensions in markets that we're seeing. And I think what we're beginning to spot are signs that we may be getting an inflection. Now, the key question is how the policymakers react to that. It's not over until it's over, of course. And policymakers may react positively. But I think the problem is they're sort of grappling around now, trying to find exactly where they are. They're not too sure themselves. And there's a growing reluctance, particularly among key US policymakers. I'm thinking here of Scott Bessent, Treasury Secretary, Stephen Miran, the new appointee of the FOMC, and actually Jay Powell himself, chair of the Fed, to say that they don't really want to be expanding the Federal Reserve balance sheet anymore. Again, I mean, they don't want to do a QE because they reckon it's ill-directed or can be misdirected. It basically inflates asset markets over the real economy, and it really has been behind these great wealth inequalities that we begin to see, opening up in Western societies. So the argument is they want the real economy to benefit now, not Wall Street, and that is really a tension that we've got to try and work our way through. So if you look at the data, and I'm going to switch to a presentation now. Okay, so what we have here is the global liquidity cycle. And this is the cycle of money flow that is going through world financial markets. It measures money in financial markets, not money in the real economy. It is not a money supply measure per se. It really looks at, if you like, the balance sheet capacity of credit providers worldwide. So it's really the capacity of the system to lend. And what this is showing is this flow of money, and you can see that it's cyclical. This chart reflects the growth rate or the underlying momentum of liquidity flow. We've got the data here going back to the mid-1960s. It has been, I mean, we've been monitoring this, continuously for the last 30 years. So a lot of this data has been put forward in real time. And the dotted red line is a sine wave that we imposed on that or calculated and overlaid on that data about 25 years ago, in fact, in year 2000. It was derived by a Fourier analysis of cycles. It's a sine wave, and it's just been extrapolated thereafter. So what you see is what you get. It hasn't been force fitted, if you like. And basically that cycle is moving in a 5 to 6 year wave. That wave is a debt refinancing wave. So the average duration of the liquidity cycle of 5 to 6 years or 65 months happens to correspond almost exactly to the average length of debt or maturity of debt in the world economy. So hence it's a debt refinancing cycle. And it reached its low point in October of 2022. It has been rising pretty consistently thereafter, with a couple of little wobbles maybe, but we're heading towards a peak. And it may be that peak is coming now, because if you look at the latest inflection downwards, which occurred last month in September, that was really forced by the Federal Reserve, and the Federal Reserve, which seems to be taking quite a lot of liquidity out of markets. And that clearly is a worry. We've got to be alert to that. Now, the risks in the system are that if you don't have liquidity, you get a financial crisis. And I'm going to show that mechanism, and I'm going to come on to deal with what the Federal Reserve is really doing, or maybe is actually doing, and maybe what it doesn't intend to do. In other words, this could be an accident. But let's work through the mechanics of the repo market and what's going on. So if you look at the length of a cycle, you can see, according to this chart, that the average cycle is that broken black line. This ranges from 1970 to 2025. And the red line is the current cycle. So although we haven't yet started to inflect downwards, it does show that we're somewhere near the peak of a liquidity cycle. And this is clearly something we have to be very alert to. Now, what does this mean? If you look at asset allocation, this diagram shows the schematic cycle. And on the left-hand side, we look at different phases of the liquidity cycle, which we generically call calm, speculation, turbulence, rebound. Risk on is an upswing and risk off is a downswing. And then on the right-hand side, you can see what that means for asset allocation in the same phases of the cycle. So equities do really well on the way up through the risk-on phase. Cash or defensive assets are what you really want in the risk-off downswing. Bonds excel at the trough, that's long-duration government bonds. And commodity markets do really well at the peak. And commodities are racing ahead now, looking at world markets. commodity prices are clearly lifting significantly. And that is really evidence of the fact that we're somewhat near the peak of the liquidity cycle. So everything kind of lines up, and that's what we intend to do when we study markets. We look for consistency and to try and pinpoint where we are in the cycle. And this suggests to us that the peak is close. Now, what are the problems if you get near a peak, and what are the risks of a market sell-off?
What Howell outlines is the broader architecture behind Lee's optimism. He believes global liquidity is nearing a cyclical peak, a point where monetary tightening has run its course and policymakers are forced to act. His charts reveal that we're entering a transition zone in the liquidity cycle. Commodities are surging, credit is tightening, and financial markets are increasingly reliant on central bank balance sheets. This cycle, which runs roughly every 5 to 6 years, is approaching a turning point. And when the cycle turns, liquidity begins to flow back in, usually triggering powerful rallies in equities, bonds, and especially crypto.
For that, we need to go to this schematic diagram, which is describing the world financial system. Now, what this diagram principally says is that at the heart of global financial markets is a debt liquidity nexus. Now, this is not the typical understanding of textbook finance, because they tend to ignore this model. Their view is that capital markets are all about raising new capital for investment projects. Unfortunately, that's a very archaic or out-of-date view. Financial markets today are all about refinancing debt. And if you look at the right-hand side text, it says something like 70 to 80% of all transactions in markets, primary transactions, are refinancing or debt refinancing transactions on our estimates. So at the heart of the system is this liquidity debt nexus. The paradox is that debt needs liquidity for refinancing, and liquidity needs debt or good quality debt for collateral backing. And on the left-hand side, you see the collateral markets, the repo collateral markets, and something like 77%, very precise figure, but that comes from the World Bank, of all global lending now is collateral backed. And that's something which has moved up substantially as a proportion since the global financial crisis. Now, in order to monitor the health of the repo and the collateral markets, two things are very important. One is the volatility of collateral, in other words, the volatility of US Treasury bonds, which are mainly used as collateral. So volatility, move index, monitor that. And the other is SOFR spreads, which is the rates in the interest rates in the repo markets, which are really reflecting whether you get a collateral or liquidity imbalance. Now, what we can see on this chart here is the ratio between debt and liquidity. And you'll see the history going back to 1980 annually, which is showing the debt to liquidity ratio. What I've done is annotated on the graph where you get financial crises. I would argue that every financial crisis in the past 50 years has really been a debt refinancing crisis. That occurs when you get high debt liquidity ratios. There's far too much debt for the pool of liquidity to refinance. And when you get that imbalance, you get a refinancing crisis, and the central banks have to come back in. If you look at the lower part of the chart, what it says there is that if you get excessive liquidity, then you get a situation where you get asset bubbles, because asset markets are the vent for excess liquidity, and you get a housing bubble, a Japan bubble, a Y2K bubble, or what we've just been through, which is the everything bubble. Now, the everything bubble was unique for two reasons. One is that when you got a crisis, be it the GFC, be it COVID, policymakers just threw liquidity at the system. So there's lots of cash coming in. And secondly, they made the error of slashing interest rates to 0%. Now, when I used to work at Salomon Brothers, the US investment bank, many years ago, the key text that we were schooled on was a book called The History of Interest Rates by Sidney Homer, who was an earlier head of research at Salomon. And that book catalogued 4,000 years of interest rate history. Nowhere in those pages do you ever read about zero interest rates. So the situation that we've come through in the last 15 years have been absolutely unique in human history. And that just underscores what an anomaly we've had. during that period of zero interest rates, debt was termed out. In other words, borrowers who were sitting on large interest rate loans that were upcoming in the next 2 or 3 years decided they'd refinance them, and they'd push that refinancing back into the latter part of this decade, the 2020s. And if you look at the graph, you'll see that the orange line is starting to shoot up, and it tests that broken line threshold sometime in 2026, 27. And that is basically saying that we're moving into a much tighter liquidity framework because more debt has to be refinanced. This chart illustrates that change in the annual debt roll on our estimates. The bite out of the chart in 21, 22, 23 was the response to zero interest rates when debt was termed out to the back end of the decade. The darker red bars are showing our estimates of the amount of debt that's coming back. And this is not the level, this is the change in the level. So these are increments of extra debt that has to be refinanced. If you get a problem in the repo markets, you'll start to see repo spreads blowing out. And this is the repo spread against Fed funds. Now, if this is a barometer, or even if you like a sort of a heart monitor of the system, you'll see that we're starting to get some pretty scary readings coming out. And the point to note is not necessarily the spikes, the scale of them, but the frequency. Because what this is saying is you've got increasing tensions. Now, we understand fully that repo markets tighten at the end of each quarter and they need liquidity. But the point here is that you've got a trend. And what's happened in the last week is you've seen spikes in repo. You've seen the Fed's standing repo facility, which is an emergency financing tranche, being used quite heavily twice. And you've had Jay Powell, the Fed chair, de facto announce on Tuesday that quantitative tightening was ending. And disjoin the dots here. There are problems with liquidity in the system. It's beginning to roll over. And you can see this evidenced in the chart. And that is what we've really got to be very, very alert to. The system needs more liquidity. The bottom line is that simply ending QT is not enough. They're going to have to do a lot more than that.
Howell's final analysis is sobering, but also revealing. He reminds us that the global financial system is built on a fragile debt-liquidity nexus, a loop in which debt requires liquidity to be refinanced, and liquidity itself depends on the existence of collateral, usually government bonds. When that balance tightens, crises emerge. When central banks intervene to restore it, liquidity floods back into markets. Right now, the repo market, the plumbing of this entire system, is flashing stress signals. The Fed's emergency facilities are being used more frequently, and Jerome Powell has quietly confirmed that quantitative tightening is ending. The implication is simple. The next phase will be one of renewed liquidity injections, whether through stealth QE or direct market support. For investors, this backdrop creates a paradoxical opportunity. The very risks Howell identifies, excessive debt, repo stress, and a potential liquidity crunch, are the same triggers that often precede major rallies in crypto. Bitcoin, by design, thrives on liquidity expansion and fiat debasement. Each time the Fed steps in to stabilize the system, digital assets gain more legitimacy as an alternative store of value. If Howell's projections hold, the coming months could see a surge in liquidity similar to the one that ignited the 2020 to 2021 bull run. And with Tom Lee's technicals aligning perfectly with that macro setup, it's hard to ignore what this convergence means for crypto going into 2025. Drop your thoughts in the comments. Do you agree with Tom Lee and Michael Howell that the next liquidity wave will send crypto higher? If you found this breakdown useful, make sure to hit the like button and subscribe for more deep dive analyses from the world's leading macro thinkers. Thanks for watching, and we'll see you in the next one.